all of the red flags that have been giving me concern.
And so the question is whether the fact that it's grown so fast, so quickly, that per se it's a weakness of the system. So it's a financial stability concern.
The trajectory has gone nearly vertical.
It's essentially widows and orphans.
If you're concerned about credit quality now, I don't want to even imagine what could be credit quality concern in that very different scenarios.
Right.
So there's a point where you have to open the box and you find out that some of the cats are dead.
The industry has shifted to sending a lot of those liabilities to their own affiliates, sometimes even their own subsidiary.
And so those that were financial stability enhancing factors, they seem to be eroding.
We need to address this as soon as we can.
What is the moment of reckoning here? What is the moment of truth? Today with me, I have Fabio Natalucci, who is CEO of the Anderson Institute for Finance and Economics and formerly at the International Monetary Fund and Federal Reserve, and Tom Gober, who is an expert and forensic accountant with over 40 years experience on insurance. We want to talk about the major topic of interest in credit markets today, which is how the private credit space is deteriorating. Is it systemic for the broader credit market? And what are the spillovers effect of the potential contagion from the private space into public markets? Now, first of all, I would like to discuss how we got here and briefly give you a lay of the land and explain what led to this current situation of worry of potential contagion in private credit. I think the basic starting point is that we have been living in a very K-shaped economy for a long time, where not the whole country, but only a part of the country was benefiting from monetary policy and fiscal policy. So the top companies were doing better. The top 1% was doing better. And in this situation, policymakers have been inheriting a very unbalanced economy. What they've done is what we call unicorn policies. So rather than solving the problem, solving inequality, lack of productivity, they have essentially accelerated the process. They have increased fiscal spending and kept monetary policy at a very loose level, which in our view has accelerated the process and has made the economy even more unbalanced. So this has been our point of view for a long time, and you can definitely watch it in our other webcasts. But the result of this K-shaped economy and unicorn policies is that there is a higher chance of tail events, whether they are positive. In some cases, you can have extreme growth. Some part of the economy can get hotter, but also negative tail risks, or left tail risks. And today we want to focus on the credit Jenga tower, the amount of debt that has been accumulating at the sovereign level and then at the corporate level, and whether this is a moment of truth for some parts of the credit market which were kicking the can and amending and extending and procrastinating losses for a long time. So what is the problem? Well, the problem is that there's a lot of debt in Western countries at the government level, rising debt and lower productivity. And this was fine until the US had the dominance of the monetary system with the dollar as the major reserve currency. But over the past 20 years, China gained market share and gained in the added value of their goods. Today, they represent over a third of production. So the West is under pressure to come up with either more productivity or to spend more or to gather more resources. At the same time, with loose monetary policy, with more fiscal stimulus, as Western governments continue in their race for productivity, for stimulus, for growth, we have essentially developed a situation where asset prices have gone up and risk premia have become extremely tight. So what happened in the last few years? In the race to productivity and to resources, artificial intelligence has been the second largest capex program since the annexation of Louisiana in the United States. And this is almost an all-time record. During this period, the credit markets were obviously at very tight levels, and there was a large need for funding from AI and software companies. So what happened was that the private equity managers decided to go into credit and decided to grow their offering of debt funds, of credit funds, mostly aimed at companies non-investment grade rated that wanted to borrow. So at the same time, you had a very large capex where the United States and other Western governments wanted to invent a new technology to improve productivity and to, beat the competition, to create an edge against other countries. While on the one hand you had AI and companies needing to borrow, on the other hand you had private credit and private equity funds wanting to lend. So while in the last 10 years public markets only grew by 5%, private credit markets grew by 360%, so over 3.5 times in size. Now, typically when you are trying to lend to a lot of companies and you want to gain market share, there is a bit of an adverse selection. You're going to probably lend to some borrowers which are not always the best borrowers. And so when we saw these very fast growth in the private credit market, it raised our eyebrows and we started to question whether the quality of the companies was always great. At the same time, we saw some of the companies that we didn't like in credit markets moving from public to private. And so we started to dig deeper. And we realized that since over a year ago, the private credit space was essentially a very risky area of credit markets. Now, if you think about bond markets in the world, you've got 100 trillion of govies, which are kept in balance by central banks, by forward guidance, by what before was QE, and now it's a maintenance program. And so they don't really move a lot. Recently, they have been volatile. If inflation goes up, if oil goes up, they can become more volatile. But these 100 trillion of govies are roughly stable, have been very stable for over the last few years. Then you have investment grade debt, which includes corporate debt, munis, and mortgage-backed securities. And then you have emerging market debt. And then as you go higher on the risk spectrum, you have levered loans and you have private credit, which is the new piece in this tower. It's gone to about 3.5 trillion in size. And it's big enough to be compared with subprime, which was 1.3 trillion before the 2008 crisis. The question is private debt posing a risk to the financial system? How bad is it? And how concentrated are the losses? Well, what we know from IMF data is that 41% of private debt is in one sector, which is tech, and that there is a lot of circularity across firms that are lending to each other, that are financing each other. We also know that the price discovery process, at the time it takes for a loan that has gone down in value to be assessed and to be published by the managers, is quite long. It takes up to 4 quarters of time for these losses to be recognized. And some of these things are not new. In fact, the IMF in 2023 and 2024 published several reports about it. But it's only recently that investors have started to worry about the private credit system. Why? Well, perhaps because the Fed is not cutting rates as fast as before, perhaps because there are some losses that are emerging, like First Brands and Tricolor last year, perhaps because investors are seeing the change in the credit cycle and are asking for their capital back. But it's clear that there's all the signs of worry and concern in the market, including the entrance of late entrants to the party and cracks that are opening in companies where lending was done without the right analysis, without the right due diligence. And obviously rating agencies continue to be asleep at the wheel. And in fact, until a few months ago, they were recommending to buy the buyers, like Insurers, for example, to buy the owners of private credit because they would get higher returns on their portfolios. So how bad is the problem? Well, we know that in the private credit space, the proportion of pay-in-kind loans, so companies that don't have enough free cash flow to pay coupons on their debt, but are paying principal, so are paying paper, is gone up to almost 10%. And it's obviously concentrated across some of the managers. So there is an amount of companies in the credit portfolios of private credit firms which is essentially already unable to pay coupons. And it's quite high. It's very large compared to the public market. And we know that there's been a lot of amend and extend and a lot of most credit events, over 90% of credit events in private credit funds are extensions. So there's not been a restructuring, not been a recognition of these losses. So essentially it's like having a lot of cats in a box. Some of them are dead. And until you open the box, you don't know whether they're dead or not. Now, the big question is whether this is a systemic problem, whether this can cause a broader spillover in the credit market, whether we should be worried about a spillover to public markets, for example. So let's just look at the numbers here on slide 22. We've got the managers. We've got 3 trillion of private credit assets. and we've got 16 trillion of private equity assets. There is a number of buyers of private credit assets. The largest buyers are life insurers in the US, and with Tom, we'll talk about why. The life insurers are 35 trillion in size, and some life insurers are owned by private equity managers. Those are 1 trillion in size. They are also buyers, the insurers are also buyers of levered loans, of CLOs, and more broadly, investment grade and high yield bonds, which are bigger markets than private credit. Levered loans are 7 trillion, and the high yield bond market is around 4 to 5 trillion. So a lot of people have said this is not systemic, it's not big enough. Banks are not involved. Well, it appears that this is the mirror image of the CDO and CDO squared over-leveraged situation that we had in 2007. In the past, you had investment grade collateral, which was levered a number of times. Here, it's high yield. In the past, you had mark-to-market, and here you don't. And in the past, you have banks, and here you have insurers. So, Fabio, tell us what you think about Contagion, and what are the systemic risks and the spillovers from a potential downturn, a potential default cycle in the private credit space?
Thank you for inviting me. I think a useful starting point is maybe to start with the benefits that I see in private credit as an approach to credit provision to the economy, which is it's a much less bank-centric, much less concentrated in one specific part of the financial system that we know for centuries now that can become systemic very quickly. You don't even have to back century, you can go back to 2023, right? Silicon Valley banks. So I think that spreading of risk across the broader financial system to players that have different investment time horizon, different risk appetite, different liquidity needs. In principle, that to me, it's a financial stability enhancing feature of the private credit as an ecosystem. Now, that said, the way I would think of this is one is the speed of growth, right? And so the question is whether the fact that it's grown so fast, so quickly, that per se it's a weakness of the system. So it's a financial stability concern. Now, one thing that I think we want to clarify here, that when at least the work that I've done when I was at the fund, private credit here means direct lending. So it's primarily credit extended to, say, middle market or larger firms, but it is primarily corporate debt. The market has been evolving though since then and is trying to find new venues for growth, right? At some point you ran out of corporates that you can lend to. And so there's been two venues of extension of the market. One has been toward different investor base, so beyond the traditional institutional investor or the pensions, the investor, the family office, if you want, the insurance companies. And so retail has been the last extension in terms of broadening the investor base. And I'll come back to retail, why I think it's so crucial here. Then the other dimension of expansion has been beyond corporate credit, for example, into what we call specialty finance, or more broadly speaking, right? Particularly the focus has been in the last few months on infrastructure and specifically data center. Some of the larger asset managers have become an important source of credit extension to the financing of data center. And now I'm taking a broader definition of private credit also to include investment grade, not necessarily just sub-investment grade. And so what are the traditional transmission channels? Usually you look at stuff like liquidity risk, right? So the selling point initially was because we have institutional investor, they don't have daily liquidity needs. They can take a long investment horizon, insurance, pensions. The traditional run liquidity risk is not there. There is no daily liquidity provision. Your capital is locked up. You understand, you're a sophisticated investor. You understand that you're not going to need the liquidity back very quickly. That's where I think the extension, the broadening to the investor base, like a retail investor, could be the Achilles heel of this industry now. We have seen a number of episodes here from the Blue Owl that has been reported on the press. I've seen also other examples of, for example, BDCs that traditionally every quarter you have tender offer up to 5%. They have been either in the face of much larger demand for liquidity. They have either met those liquidity needs. Blackstone, for example, I think if I remember the number, it was almost up to 8%, including with capital injected essentially directly from the firm and some employees, or other example where the demand was large, but that the gate, if you want to use the word, I'm not a big fan of that gate, but the 5% essentially has been raised. That's where demand for liquidity, when the underlying is such an illiquid asset, that's where one of the tension can be. The second channel of transmission could be leverage. You mentioned, Alberto, leverage. I think here is not the amount of leverage per se, it's the layering of leverage, right? So leverage in the borrower itself, obviously, those are sub-investment grade corporates. Maybe the data center, those are a different animal. But then you have the leverage at the fund level, whether this is portfolio lending from a bank, whether this is the subscription call lines, and then the potential addition of leverage at the investor level. That layering, that's where I think there is very lot of opacity. We just don't know at the aggregate level how much financial leverage has been employed, how this layering would play out in a deleveraging episode, and if we bring back liquidity risk from the back door to retail, how that liquidity demand would actually interact with leverage in a non-linear way in a stressful situation. One last point in terms of the leverage, turns out that all this leverage primarily is being offered by banks. So if we thought that we move away from this bank-centric system and in a more decentralized, if you want, financial system, well, the banks are coming back from the back door. Now, I don't think the amount, personally, and based on what I know, I don't think the amount of leverage is comparable to previous financial stress episode. Those are portfolio of loans that are usually over collateralized, so you need significant amount of moves there. Another vulnerability here is the interdependency, and I think we're going to come back to this, but it's a very broad ecosystem. There are all these institutional investors. Now you have retail, you have banks, you have asset manager, you have a very, in normal times, this is a positive, but under distress, liquidity calls, deleveraging, it's possible that if you don't have access to your illiquid asset, you may be forced to sell something else. And usually what you do, you sell what is liquid, right? So if you're an institutional investor, you would sell equity or you would sell investment grade debt. That's another transmission channel. There are two more I think we want to keep in mind here. One is the discussion about credit quality. There was one of the selling point of this industry is that it's a very diversified exposure to different industries. The numbers, one you mentioned, that 40% from the fund, I've seen also other numbers, maybe a little lower, but in the same range. The exposure that the industry has to, for example, software industry, if you take a much broader definition of related to a narrow definition, and also with AI disruption now cutting across different industries, how much of the credit quality underlying actually could deteriorate fast if there is significant disruption by AI. And then last point, I think, has to do with opacity, right? Again, one of the selling points is this is not mark to market, not on a daily basis. So even if you have leverage, you don't mark to market. It's a sophisticated investor, they're okay. And that was a selling point when you have idiosyncratic stress, right? One company comes under stress, you don't have to mark to market. You can actually extend, for example, additional debt and you avoid bankruptcy. When this is systemic, it's a very different exercise, right? The example of the few names I mentioned before, where either you raise the gate essentially and provide liquidity, or in some case they blew out where they reportedly sold $1.4 billion of debt. Once you start selling, or there are tender offer, like there was Saba Capital that decided to offer to buy some of those shares at like 65, for example, if I remember the number. Once you start actually having actual transaction, those becomes marks that they're valid across the industries. And when you start marking that way, that to me, that's recall of like the Lehman, we're going to mark it up here. And then when finally you have to sell, the mark collapse down, and then everyone needs to account for that mark.
So there's a point where you have to open the box and you find out that some of the cats are dead. And to some extent, we have seen this in the past few days. We obviously have been following this for a while. We've been, I think, among the earliest people to talk about the private credit phenomenon and to be short since over a year ago. So we've been very concerned. But now the question is, as you were saying, it looks like the buyers of private credit might be using leverage. So you have the insurance companies, you have pension funds, but the larger buyers by all means are insurers. And why? Because some of them are also owned by the managers.
All this stress that you see in credit quality here, we need to remember those are happening at a time where the economy is is growing, right? It's growing strong, close to potential. There are talks about productivity gains. If you are concerned about credit quality now, if the economy slows, if you get close to a recession, if the productivity doesn't materialize, if you're concerned about credit quality now, I don't want to even imagine what could be credit quality concern in that very different scenarios.
Right.
I mean, if you have 10% of dead cats in a very good market, you might go to 30% in a bad market. And by the way, the issue here is not that investing in software technology is a bad thing per se, but when you invest in a credit portfolio, you're essentially betting on the losers. If you're investing in an equity portfolio, you could have 5 names doing really well and 5 names going out of business, but you're still making money because you might be making 10x on those 5 names that are going well. But in a credit portfolio, you're making 3% on the winners and you're losing 50 cents on the dollar or more on the losers. And the spreads at which the industry has been deploying capital were pretty attractive 3 years ago, but they've become really thin. So the returns, according to data from private equity and private credit firms, the returns that have been generated are in the mid to high single digits, in the best case scenario, as you were saying. So the margin is very thin. But what I've discovered, which is very curious, and is the layers of leverage. So you've got insurers that are buying private credit. You've got private credit managers putting private credit loans into business development companies, which are also levered. And then you've got the insurers issuing funding agreement backed notes, FABs, which are collateralized notes that are issued out of their own assets, securitized assets, rated higher, and then they repo them to themselves to get more funding leverage. And then you have the reinsurers, and some of the reinsurers are also owned partly by the same groups, and they are reinsuring the insurers. So you have a lot of layers of leverage which are probably hidden and probably not clear to everyone. So when you just look at the 3 trillion of private credit, you might say, okay, it's one part of the credit market that is bad, but it's isolated, but the ramifications are quite large. So banks have exposure, insurance companies, and particularly private equity-owned life insurers have a lot of exposure, and there are some which have a very limited amount of surplus to liabilities. Tom, you've been 40 years in the field, over 40 years in the field, in the trenches of forensic accounting, but also on the field, sometimes undercover, working on specific missions to find out whether companies were telling the truth or not. First of all, given your experience, I want to ask you, what is the most interesting experience in your career, like the funniest or most symbolic example of what you've done on the field? If you can tell us about that. And then how bad is the situation now versus what you've seen over the last 40 years?
I also thank you for having me on. It's a privilege. Boy, it's been a challenging 41 years, I got to tell you. Probably the most meaningful were those 12 years when I assisted federal law enforcement in working criminal cases involving what we're talking about today, non-transparent reinsurance. They call it reinsurance. Every case resulted in lengthy prison sentences, and more importantly, we got the money back for the policyholders. That was good. That was a very valuable experience. And thanks to federal grand jury subpoena power, I got to see the tender underbelly of an industry that not many have seen. So yeah, that was probably the most meaningful period. As far as what's it like today, I would say that the last 7 years has been a fairly gradual trajectory upwards in risk until just the last 2 years, the trajectory has gone nearly vertical. All of the red flags that have been giving me concern in the last couple of years have taken off. And it is mostly in the private equity controlled life and annuity carriers, but there is some out there in the publicly traded market as well.
So your job has been to essentially protect the policyholders, which are the ultimate responsibility of a life insurer. Now, your job always starts from data, right? From numbers.
Right.
Similar to ours. The difference is you go much deeper into the accounts of each of the entities that you're looking at. So we thought that, there's a lot of top-down discussions in this around the sector, and we thought it could be interesting actually to look at an example and to show everyone the numbers that are public on the balance sheet of Athene annuity, for example, which just released the full year 2025 numbers. So if you think about Athene, which is owned by Apollo, and it's if I'm not wrong, it's a 340 billion balance sheet, so it's a sizable entity. What are we seeing here? How much capital do they have against the total liabilities, and how much do they have in private assets? How is the situation for Athene, as an example?
First, let me say that anytime I talk about specific concerns of any carrier, I always use the source document. And that has to be the statutory annual statement, what they file with the state regulators. The industry often wants to talk about the GAAP consolidated financials, which helps investors see patterns of earnings and profits into the future. But you got to remember, life and annuity carriers are very unique. The policyholders timely pay their entire life, and all they get is a promise, a very long-term promise that the company will be there, will be strong, and will be able to honor their claim, which might be as far as 100 years from now. Some people purchase a life insurance policy for their child at birth. So with that extremely long-term commitment, the statutory accounting principles require certain things. One is they demand transparency, and I am seeing dramatic lack of transparency in recent years in strange ways we can talk about. But Athene, that's Athene Annuity and Life Company, is domiciled in Iowa, and it is owned by Apollo. It has what I would consider one of the thinnest surplus buffers. This year, in 2025, about 1.2% of total liabilities. And the national average is over 7% versus their 1.2%. But a lot of the companies are up in the 10%, 12% surplus to liabilities.
So here, essentially, what you're saying when you talk about the policyholders of life insurance, it's essentially widows and orphans.
No doubt.
With a very long-term claim. And the numbers that we see here are 336 billion in total liabilities, and the equity is 4 billion. If you had a 1% loss on the assets, that could wipe out the whole surplus.
Exactly.
And how much of that asset, of that balance sheet, the 336 billion balance sheet, how much is it in private assets?
It's a little bit difficult to quantify because of the way they report statutorily, but I can tell you that Athene, the Iowa carrier, is heavily invested into their own paper, affiliated investments. That's over 50 billion at this point versus the 4 billion in surplus. But they also have very large levels of the categories of bonds, such as other loan-backed and structured, which are not residential mortgage backs or commercial mortgage backs, but backed by other, like student loan debt, stressed credit card debt, that sort of thing. They also have a lot invested in limited partnerships and joint ventures tied to commercial real estate.
And I believe that according to the investor presentation, the portion of private assets is around nearly 50%, 48%, although part of it might be investment grade. But clearly, the lending standards that we have observed in the private space are more loose, as Fabio was also saying. So essentially, what you're saying here is that there is a number of red flags, right, that have continued and potentially increased for a long time.
Right. The things that I watch in general across the board and have for years are things like, first, surplus being too thin. And let me quickly say, it's unlike any other industry. The surplus is not allowed to even go to zero. Using the risk-based capital calculation, the NAIC, the National Association of Insurance Commissioners, and the state regulators, they want to know when the surplus gets to a certain level before it even goes negative. An insurance company can't go negative. It has to have a buffer. These buffers have gotten so thin, and even thinner than what most people can see, because of their significant reinsurance portfolios we can talk about in a moment. But yeah, the surplus is, in my professional opinion, significantly low with respect to the private equity controlled carriers.
And what are reinsurance doing? What are the reinsurers doing? Is it essentially a situation where you have, a snake eating its own tail? So there is a reinsurance that's affiliated with the same group, reinsuring the assets of the insurer, which in turn can buy more risky assets.
Yeah, it's it's a really important question. Until the last several decades, virtually all reinsurance was as it should have been. The company that offloads the liabilities would offload it to a totally independent reinsurer. The whole concept of reinsurance is sharing genuine risk. It's got to have real risk transfer. But in recent decades, the industry has shifted to sending a lot of those liabilities to their own affiliates, sometimes even their own subsidiaries, which, in my professional opinion, is more sleight of hand than genuine transfer of risk.
Fabio, what do you think regulators are doing? Why is this not on their radar? And you've been in the policy side for a long time. Now you're on the private side. What do you think it takes for regulators to start looking at this problem, which potentially could endanger the assets of policyholders later on?
I'm not sure I would say that it's not on the radar, because now it's so much in the news that I think it's on everyone's radar at this point. I think there is a question on how to monitor this and not just look at the rear mirror, but looking at the front mirror, looking ahead, right? And then there's an issue, a question of what are the tools. I'm going to focus in the US, I think, for a second, because that's where the largest share of private credit is. And we need to also be clear what we're talking about private assets here, right? We're talking about just corporates? Are we talking about sub-investment grade? Do we have also investment grade? Is this real estate? So I think that's one thing to clear up with numbers and with concern, right? Obviously, an investment grade exposure is different than sub-investment grade exposure. I think the issue is monitoring, and this is why it's so challenging, right? Even when I was at the fund, essentially there's no really data that you can look at. And again, the fund, the work we did at the IMF, we did not use supervisory regulatory data. So we did all that work using public data, commercial data. And then the other thing we did, which was possibly the biggest part of the effort, we went out and talked to people, trying to really understand the business model. We talked to banks, we talked to asset managers, we talked to institutional investors. That's the part to me that is crucial in a forward-looking part. If you really want to understand this trend, you want to understand before they get vertical, like Tom said, when the slope is a little, it's flatter, right? And so that's the big part of the effort. That requires that you get out of the building, that you are humble enough to say, I don't know this. Can you explain it to me? You're curious enough that you want to understand how the market structure is changed. I think that's the most challenging part. I'm sure that there are people at the Fed that are trying to do this, but particularly in markets outside of the traditional regulated banking sector, this is more difficult to do because it relies on you just getting out, asking questions. You need to have contacts in the industry. You need to know people in the a specific financial institution that they're willing to talk to you. You need to clarify. Obviously, I'm not a regulator. I'm not here to look at that specific firm book of business. I just want to understand the trends in the industry.
You were early on this, but now some other regulators are catching up.
You can see there are reports, right? I can point to like international institution reports, central banks report like ECB, the Federal Reserve. What they have, which I didn't have when we did the work, I don't have firm level data and their exposure. And I think one way to think about this, which is where they obviously have an advantage compared to everyone else, is just focus on leverage, for example, right? A lot of this leverage in one form or another comes from banks, whether this is portfolio lending, whether this is capital calls, whether this is systemic risk transfer. Somehow from the front door, the back door, the window, it lands up on the bank balance sheet. Those data are available, generally speaking, and if not available, you have the power as the supervisor and regulator to actually ask those questions. So I think there is less of an excuse there if you're missing something, because there is a way to see what comes back on the bank's book. That's, I think, the part on the regulator. What can you do, though? That's the even more relevant question. Because to the extent that some of these risks are building outside the traditional banking sector, that are regulated by other either federal agency or at the state level, I think because there are so many investors and different type in this ecosystem, this is when it gets difficult to have an overview, a systemic view of the entire system, and that's where I think the tool are lacking, right? The only tool really available, again, is through the banks. Anything that goes through the banks, whether it's liquidity provision or leverage liquidity or leverage, that's where I think you can actually have a tool to directly affect some of these dynamics. The macroprudential tools in the corporate credit space, where you can go after non-banks, they are very limited and they're very fragmented. The same way the ecosystem is fragmented, on the public side, there is fragmentation in terms of who covers which entity involves in this very broad ecosystem. That's where, to me, I think is the weakness of the system, because many of these agencies, they also don't have a financial stability mandate. And if there is an actual crisis, they don't have the crisis management tools that in the end only the Federal Reserve had, right? And we have seen in the past few crises, we have seen with COVID, when they ended up backstopping investment grade corporates, sub-investment grade ETFs, that becomes the only game in town. And that's why I think this is so dangerous.
That creates a lot of moral hazard, because if you know that the Fed is going to bail you out at the cost of the taxpayer, then you take more and more risk. But obviously,
you want to create a situation, though, where I think it's unfair to say when you are in the middle of the crisis that the Fed should not act. I think you want to build resilience ex ante, so you reduce the likelihood that you get to that stage where you need to step in and backstop the system.
Yeah. But it appears to me that a lot of regulators in Europe and the US have been focusing on the past crisis. So they've been looking a lot at banks and looking a lot at bond markets and securitizations. But this, the private market has fallen through the cracks until recently, where there's a lot of discussion about it, and also it's starting to affect banks and insurers. Now, we looked at Athene, right, because it was just one of the last released statements. But, how bad are the other guys in the room? How bad is, Global Atlantic, which is owned by KKR, or, some of the other insurers like, Brookfield or, BHF? Are you seeing similar trends, Tom, across the balance sheets that you've been looking at, for the last 40 years? Red flags, thin surplus, large percentages of private assets, potentially non-mark to market. Of course, not all high yield. Some is investment grade. But are you seeing similar trends? Is it some sort of race to the bottom that has happened across the insurers? And what is the moment of reckoning here? What is the moment of truth?
Yeah, first, yes, I'm seeing a pattern across all of the private equity controlled life and annuity carriers, an increase in risk a decrease in transparency, a thinning of surplus. All of them share that. KKR owns the Global Atlantic companies, 4 of those. Brookfield owns 2, one in Texas and one in Iowa. And the Iowa company has some of these captives. In Vermont, 3 captives that we can't get public financial statements on. So I am seeing patterns across that whole group. But I also want to say that the pattern really started before private equity got involved. Private equity saw what was going on in the industry and probably thought, well, we can do that even better. But what happened was, remember, just when I started as an examiner 41 years ago, most of the carriers were mutual. They existed only for their policyholders. There were no investors reaching into the pot and pulling money out. So if you think about that a minute, once a company demutualizes and is publicly traded, stockholder dividends, if you go back and look at MetLife and Prudential, instantly, the moment they demutualized, they began paying significant stockholder dividends, and it went up nonstop for decades. That money is coming out of the pot. And so a pattern that I noticed was, as cash was being pulled out, it had to be filled with something. And what I noticed was during that same time period, a significant loss of transparency, because they began transferring liabilities to these people didn't even know they existed. They call them captives, but they're subsidiary reinsurance companies owned by the insurer. They're public. Their financial statements are not public at all. And once the liabilities go over there, we have no idea if they're properly funded. What are the assets? So the first decade, those captives started at 12 billion nationally. All of the insurers had ceded 12 billion to these captives. In a decade, it went from 12 billion to 440 billion. And that's something we can't see. And so that pattern had begun developing before private equity got involved. But as soon as private equity got involved, everything ratcheted up. The captives began using more of the captives and going offshore with substantially higher amounts.
So essentially the risk, what you're saying is that the risk is moving from one box to the other. And at some point it moves, from the funds to the insurance companies that are buying them, which were supposed to be very conservative institutions. Some of them still are. And then it moves to the reinsurers, which are more hidden and very often not public, right?
Correct.
So one last question, Tom. So we talked about leverage across, there's leverage across the companies that are borrowing, of course. Then there's leverage in the private credit funds around the business development companies, which are the SPVs that these loans are put in. And then there's the insurance companies, which also have leverage because they have a limited amount of surplus capital over total assets. But then there's other layers of leverage as well. The reinsurers, that is selling protection on the insurance company. But the insurance company itself is also funding itself with GICs and also FABNs, all sorts of other instruments to get more funding. And sometimes they're borrowing from banks. So what are these instruments and how big are they?
Yeah, this is really troubling because the industry is quick to say, we know how to match liabilities and assets. We have long-term liabilities. But in recent years, that has changed dramatically. Some of the more aggressive companies have very high levels of these, what are known as deposit type contracts in the annual statements. One company's up around 70 billion, and there are quite a few companies in the 60 and 50 billion range. What that means is they do not report that as leverage. There's a line item on the balance sheet. It's called borrowed money, and they all have zero. Yet, the funding agreements and these GICs, deposit type contracts, are short-term borrowing. And my biggest concern is that even though the industry is quick to say that if those institutional investors demanded their money back, we could put them on hold. We could ask them to give us 90 days. My concern is if there is a significant liquidity stress event, I'm afraid those big investors are going to ask the company to give their cash back. And I'm afraid they're going to have to give it, or the dominoes will begin to fall. And if that's the case, a lot of the most liquid, the best investments will be sold first to go to the investors, and leaving the policyholders with the less liquid stuff. That's my immediate threat. I think that's a big problem.
Yeah, and of course, when you're selling assets, you're only able to sell the first assets that you're able to sell will be the higher quality assets. So you're reducing the recovery rate of the people that are going to have redemptions later on. I mean, Fabio, what do you think about this? What are your conclusions here? How worried are you from 1 to 10?
I think my issue is like there were some premises here that made this sector potentially financial stability enhancing, right? Moving away from banks, reducing the liquidity risk, the fact that mark to market was not on a daily basis, so allowed you to essentially look through some of the idiosyncratic events. My concern is that some of this is gone now, both with the expansion into the retail investor and more broadly into like different asset classes as well. These different asset classes have different duration, different correlations, and we have not seen how that play out. Again, particularly if there is a significant slowdown. And so those that were financial stability enhancing factors, they seem to be eroding. And we go back to the old list of vulnerabilities that we have used in the past for other crises. Now, every crisis, when there is a financial crisis, doesn't look like the past one. So I think we need to try to be creative. I think what could be playing out different this time, it's just starting to see signs of the old style driver of financial instability. I think that's my main concern.
I'd like to close with one concern. A lot of people don't realize, but the life and annuity industry in the U.S. is regulated at the state level. Each state has a commissioner, and they are understaffed and underpaid, and they are charged with regulating a very complex industry, now a global industry, especially the reinsurance. I have sent numerous letters by certified return receipt to Iowa, Vermont, Texas, regulators where I have serious concerns, and I've asked them to please get back, and I've gotten no responses. So I'm urging the state regulators to listen to these concerns and to recognize we need to address this as soon as we can. Thank you for that.
We have been very vocal on the complacency in credit markets over the past few quarters. We've been following the private credit developments. We look at all credit markets globally. We've been following the private credit developments in particular because we saw that the companies that we didn't like were essentially going and switching to private, and then we started to dig deeper and deeper. And what we see right now is an environment where investors have been buying risk assets for capital preservation. Investors believe that inflation will be above target, and Western governments have been spending, and Western central banks have been keeping rates low in a race to compete with the East. But the casualty could be that in the process of stimulating the economy and keeping it so hot, some asset bubbles have been also created, and in a different way, in a similar but different way from what happened in 2007. This time around, it looks like it's high yield and opaque assets, illiquid assets, rather than investment grade. There is leverage, but it's at the end, not at the beginning of the process. And insurance are affected, but also banks, rather than banks in the first place. So the extreme stimulus the combination of the second largest capex in US history, being above inflation target, and keeping rates low for 5 years has definitely generated some capital misallocation and some asset mispricing. And we continue to be concerned. We've been short the private credit ecosystem for a long time, since over a year. We continue to be, and we continue to be very concerned about the developments over the coming months, where either high inflation, higher oil prices could trigger credit volatility or a reduction in growth and a disruption from AI in some of the sectors in the economy. I want to thank Fabio and Tom for participating, for their time, and for sharing their multi-decade experience with us. And I want to send a big good luck to investors, and please feel free to come back to us with any questions, and good luck for the rest of the quarter. Thank you.